Hello friends, welcome to my webinar series Financial Bytes Dhantripti. I am Arun Mathur. I am a certified financial planner and a founder of Dhantripti Financial Planners. Today we are going to talk about capital gains tax and how we can use it, the lower taxation, to our advantage. So let us get started. What we are going to cover today is what is tax, how is capital gain tax different than income tax, which is more widely known, what are the various terms which are related with capital gains which we need to understand, how do we calculate capital gains and the tax using capital gain tax rates which are very different than the normal slab rates. And in the end, we will talk about how we can take advantage of this lower capital gains tax by taking few actions. Moving on. So what is tax? It is basically a mandatory financial charge or a levy which is imposed on an individual or a legal entity. And this individual and legal entity together are called taxpayers. So who does that? It is done by the government. And why do they do it? Because it's a source of revenue for the government, which is required by them for their spending and for public expenditure. There are two types of taxes, direct tax and indirect tax. Direct tax is one which is directly paid by taxpayers to the government, while indirect tax is one which is collected by an intermediary who is usually the seller of goods and services. He collects it from the taxpayer and then deposits it with the government. Some of the examples of the direct tax are income tax, wealth tax, and the capital gain tax, which we are going to talk more in detail. The indirect taxes are excise duty, sales tax, and goods and service tax, popularly known as GST. So moving on, let us try and understand the difference between capital gain tax and income tax. Both are actually direct taxes, right? However, income tax is a tax which is placed on an income coming from four primary sources, while a capital gain tax is on capital gain, which actually is the fifth source of income. The four sources of income are salary income, business income, property income, which is basically a rental income, and all other incomes do not fall under these three heads are considered as income from other sources. You just add all these incomes, you get a gross total income, then you are allowed some reductions and some deductions which you reduce from this and you arrive at net income tax, net income. And on this income, based on the tax slab in which you fall, you have to pay a tax. So tax rate as per your slab will give you the total tax. So this is how income tax is calculated. Similarly, tax on capital gain. So what is the capital gain? Capital gain is basically the profits or the gains which are coming out when you transfer a capital asset. And we will take a minute to understand what's a capital asset in the next slide. So this is a tax which is put on an income under the head capital gains. And capital gain tax slabs or tax rates are very different than the income tax slab rates shown on the right. An important point to note here is that this tax gets triggered only when the asset is sold. Okay, so we talk more about it in the subsequent slides. Okay, so now let us understand there are certain terms which we have to really understand before we can understand more about capital gains. There are mainly five terms. The first term is capital asset. So capital asset basically it is an investment or an asset which helps us to generate money and is not for our personal consumption or enjoyment. Now, similarly, capital assets can be of two types, short-term capital asset or a long-term capital assets. How does that depend? That depends upon the holding period of an asset. Okay? If an asset is held for 36 months or less, it is called as short-term capital asset. While if the asset is held for a period more than 36 months, it is called as long-term capital assets. However, there are few exemptions to the rule or the exceptions to the rule. For example, for real estate property, this 36 months is substituted by 24 months, and for shares, equity mutual funds, bonds, this is 12 months rather than 36 months. The second term which we have to understand is the sale value of asset realized, and this is quite self-explanatory. So this is the amount which, or the amount of money which you will gain once you are selling an asset, right? The third term which we need to understand is the cost of acquisition oblique of improvement of an asset. So whenever you are buying this asset, you are paying some cost or you are paying some price to the seller. That is known as cost of acquisition. And later on, if you spend some money in improving the asset, that is your cost of improvement of an asset for you. The fourth term, let's come to the fourth term. The fourth term which we have to understand is the indexed cost of acquisition. So in the previous slide, we have understood what is the cost of acquisition and improvement. Now, government has given an advantage of inflating your cost as per inflation index called as CII or cost inflation index. Now, this helps us in reducing the capital gain and thus the tax. So, the cost of acquisition is thus calculated using this formula. Index cost is cost of acquisition multiplied by CII in the year of transaction divided by the CII in the year of acquisition, where CII is a cost inflation index and it is declared by the government every year. And you can see it in the table. So let's take an example to understand. Suppose in the year 2001 you bought an asset for 1 lakh, right, and sold the same in the year 2012. So CII in 2001 2 is 100 and CII in 2012-13 it is 200 as evident from the table. So your index cost of acquisition becomes 1 lakh multiplied by 200 divided by 100 equal to 2 lakhs. You can thus see that the index cost of acquisition has doubled. You will see in subsequent slides that this will help us in lowering our capital gain and thus the capital gain tax. The final term which we need to understand is the capital gain or the capital loss. Again, as you have two types of capital gains, you similarly have a short-term capital gain or loss and similarly long-term capital gain or loss. Okay. Now let us move on to understand how capital gain is calculated. So again, logically, there will be two types of capital gain as we just saw. Short-term capital gain on sale of short-term asset and long-term capital gain on the sale of long-term capital asset. Let us first try to calculate short-term capital gain. In order to do that, first is you have to list down the full value of the sales consideration. Then you list the cost incurred in above transaction. That means the sales transaction, whatever cost you are incurring, you write that down. You also write the cost of acquisition of asset, cost of improvement made in asset, and these terms we have already understood in the previous slide. Having done that, then you arrive at short-term capital gain by subtracting B from A. Similarly, you can calculate long-term capital gain. Again, it is done in the same manner, the only difference being that instead of taking cost of acquisition and cost of improvement as deduction, we take indexed cost of acquisition and indexed fixed cost of improvement. And you also have one more deductions which is available under section 54, mainly on account of investments made in capital gain bonds and capital gain account. So finally, you will get the long-term capital gain as A minus B minus C. Now, having understood the capital gain, how to calculate the capital gain, we need to also understand the tax rates which are applicable on capital gain. Now, tax rates here depend not only upon the type of capital gain, means short term or long term, but also on the type of assets. So, the short term capital gain has got two tax rates. Two tax rates are there. One is the normal tax rate and other is a concessional tax rate. The normal tax rate is applicable on all the assets, and that means whatever tax slab the payee taxpayer is in, that tax rate is applicable for short-term capital gain. For certain type of assets like listed equity shares or equity mutual funds and business trust units, etc., there is a concessional rate of 15%. Similarly, long-term capital gain also has got two tax rates. 20% with indexation means you have allowed to put indexation, as we just saw in our capital gain calculation, indexation on long term and on the cost of improvements and cost of acquisition. And after that, there's a tax of 20% on all the assets. Again, you have an option of taking a lower tax rate of 10% but without indexation on certain types of assets like listed financial securities or zero coupon bonds. These are the exceptions which are allowed to be taxed at a lower tax rate. So now these some of these taxes have been like for example prior to 2018-19 the long-term capital gain tax was nil and it has been reintroduced since then, and tax applicable in the 10% tax applicable on these financial securities is also calculated above one over and above 1 lakh of capital gain. That means up to 1 lakh capital gain is not taxed. And then finally, to arrive at the tax rate or the tax payable, you have tax rate multiplied by the capital gain. So, having understood everything about capital gain tax, how the capital gain is calculated, the short-term capital gain, the long-term capital gain, let us look at some of the advantages of capital gain tax. Primarily, it firstly it is a potentially it's a lower tax due to lower tax rates. We just saw that tax rates are in the range of 10%, 15%, or 20%. So a person in a highest tax slab of 30% always gain from a capital gain tax. Similarly, second advantage is that the sometimes it is not necessary that when you sell an asset you will make a capital gain. You can also make a capital loss, and this capital loss are you are allowed to carry over for next 8 years, and it can be set off against future capital gain. So even capital loss does not go waste. Thirdly, one has the advantage of deferred taxation, means you are liable to pay tax only when the asset has been sold and not on annual basis when the asset is getting appreciated year after year. This is another advantage where you are not paying the tax immediately but you are deferring the tax payment. But how can we as individuals take an advantage? So what is the action we need to take so that we can benefit out of it? Firstly, for example, most of the people are parking their surplus funds, which is either a liquidity, trying to maintain liquidity, or it is their emergency money. So put them in a liquid mutual fund rather than putting them in a fixed deposit, because liquid mutual fund will will be charged potentially at lower capital gain tax than fixed deposit, which is taxed at your slab rate. Secondly, whenever you invest in mutual funds, go for growth options rather than dividend options. Because again, in growth options, when you will sell mutual fund, you will be subjected to capital gain tax. While if you take dividends every year, then you have to pay as per your tax slab. Thirdly, always try to grow your wealth by capital appreciation of an asset, not through annual interest. So let the asset keep on growing. Do not try to take money out of it in between in the form of interest, right? This will again help you to be subjected to capital gain tax rather than normal slab rate tax. And finally, hold your investments for a longer period of time. This will help you to surpass the time period of 12 months, 24 months, or 36 months, depending upon the asset you are holding. And therefore, you will be subjected to long term capital gain rather than a short term capital gain, because the long term capital gain tax rates are lower than the short term again. So, it will turn out to be a lower taxation for you. So this is all about what I wanted to share with you. So if you want to know more, or if you have any more queries, you can write to me with your suggestions or your queries at my email address arun@dhantripti.com, or you can call me on my number, or ping me on my WhatsApp. If you like my video, please subscribe to my video channel, and also visit my website www.dhantripti.com to know more about me and my financial planning services. Thank you.